Good morning and welcome to our farmdoc crop insurance webinar for 2015. I'm Gary Schnitke, and with me today is Bruce Sherrick.
Good morning, Bruce Sherrick here as well.
And Nick Paulson, good morning.
Get ready to go. So as we're going through this, we're going to ask a couple polls here. So we're going to start here. So you should be seeing a poll here. And which best describes you? Landowner, farmer, both farmer and landowner, crop insurance agent, and other. And again, just if you would, just click on that and we'll give you the results here pretty quickly, just to get us a feel for who's here and who's with us today. We have 69% voting, 73% voting, so we'll get this up here pretty soon. Again, what we're going to do is cover some of the things that are new this year, and actually even with these new things, we're not suggesting too large of changes to your Farm Bill program. Here you can see, I think you can see the results of the poll, and 16% of your landowners, 14% farmers, both farmer and landowner, 32%. So most of you are falling into the farmer landowner category. One other poll before we get going here. Where are you from? Just one more poll, and then we'll get on with the process. Are you in Illinois, other Midwest states, other area in the United States, and outside of the United States? So, if you wouldn't mind answering that poll, we'll get a feel for where everybody's at. And again, we will give you the answer to the poll. And again, this is just to get you warmed up, and so you're not just sitting there doing nothing at 8:00 in the morning. Here's the answer. All right, 53% are Illinois, as you would expect. We're from Illinois. 35% other Midwest states. 9 of you are from other area in the U.S., and 3% from outside the United States. Thanks for taking part in that poll.
This is a global webinar then today.
This is a global webinar today. So what we're going to do today is go over several things. Usage, we're going to demonstrate, so we're just going to show you where people have been using crop insurance in the past. And again, if you're in one of the two major use categories, you'll probably want to stay there this year. We'll give you some look at some tools that you can use to evaluate crop insurance. Then we'll particularly talk about SCO and YE, two of the items that are new this year, and describe those. And then finally come down to recommendations, or what sort of the products we would be suggesting for the coming year. Here's percent acres insured in the U.S. So this is a U.S. look at it. This goes up to 2014, and you'll see that all the major crops were actually close to 90% insured, and those have been increasing over time. One blip there in the 95-96 period when participation in crop insurance was required to be part of the Farm Bill commodity programs. There is no linkage now between commodity programs and crop insurance. So if you're worried about the commodity programs, you don't have to be in crop insurance, and vice versa. So there isn't a linkage there. That's a percent acres insured in the United States. Here it is in Illinois, and roughly the same sort of trends. We have more acres insured of corn than soybeans in the Illinois, but not by a lot. And then for whatever reason, wheat lags insured acres for corn. Again, same basic trend though. Over time, we've seen increases in acres insured. The big thing also is that we've seen within those insurance acres an increase in coverage level. And this slide just shows for revenue products, which this year, or 2014 actually, and this year for that matter, is RP, and RP with harvest price exclusion. We lump those two together, but this is the use of farm-level revenue products. And you can see the green line there is 80 and 85% coverage level. And those two coverage levels for farm level products have increased in use, and those two now account for close to 70% of the acres planted in Illinois. So this is a percent this is a percent of insured acres. You can see there, though, that farmers have been switching away from, or switching more to, higher levels of crop insurance, and those two 80 and 85% account for the majority of acres insured in Illinois. And currently, this is for corn. Again, if you want to see a little bit more detailed breakout of that, and by detailed, here is the detail, you'll see a column there for each one of the crop insurance products: RP with harvest price exclusion, YP, ARP with harvest price exclusion, then AYP. That AYP should be the last column. Those last three are group products or county level insurances, but look at the numbers in the red. RP, 75%, 8.9% of acres insured, 80% coverage level, 23.7%, and 85%, 39%. And again, if you're looking at a combination with the highest, it's RP, 85%, 39% of the acres. So those three coverage levels, RP, 75, 80, and 85, account for the majority of use. The next big one is ARP at the 90% coverage level, 6.3% of the acres. So you can sort of divide those out. The majority of acres in the state are either an RP 75% coverage level, ARP at 90% coverage level, and the rest are pretty scattered out there. But if you're in one of those two areas, RP 75%, or we're in those last year, ARP staying there likely would be a good thing to do.
And it's probably worth noting that the acres in ARP are concentrated in certain counties as well. This is not scattered uniformly across the state, but does depend on how a county is rated relative to its own history, how attractive ARP may look in that area. And likewise, the RP coverage going up is partly in response to prices going down to try to offset what would otherwise have been a decline in the revenue covered.
So those are the trends there, where we're at in corn. You see a similar thing for soybeans. So we see some similar sorts of percent acres insured for soybeans. Here's 2014 again. You can see RP 75%, 12, 80%, 23, 85%, 30. Those again account for the majority of the acres here, and then GRIP HR, which is actually ARP now, is the 3.6% acres. Again, if you're a farmer and insuring one of those acres, you're in the majority, and probably will just want to stay in that area for the coming year. Those are both good products and provide good protection. Poll. We showed you. We should have done this actually probably before. So here's a poll. Is our audience close to normal? I shouldn't have said it quite that way, but close to. If you wouldn't mind tell us which one of the products that you took here, and we'll see how representative. There you go. Bruce saved me there. I was looking for a word that I couldn't pull out of my brain at that particular point in time. So we're voting here, and we're getting close to the end here. But these are the products that we see here. You can see the results here. And 87% of you are using RP, 3% with RP with harvest price exclusion, 5% ARP. So you're pretty representative of what's going on in the state. The other question, just to see what coverage levels do you use, and 85 or 90%, 80, 75, 70, and 65%. So give us a feel for what coverage levels you're using, And again, we'll see how representative this is to what we see in Illinois. And by the way, if you're wondering, we showed you Illinois statistics. Iowa, Indiana, Minnesota are not different. If anything, Illinois may have a bit higher ARP use than other areas, but other than that, there's not much change across the Midwest. There you see 52%, again 80%, 30%, and 17%, 75%. All right, thank you for taking part in the poll. There are a number of tools here that you can use in doing a couple of things here. Just want to make you aware of those. The crop insurance decision tool is a Microsoft Excel spreadsheet. You can download that, use that to get your premiums and do what if. And then we have a couple online tools as well, our iFarm premium calculator and our iFarm crop insurance evaluator. We will show you where you can get those on the web. This is just a screenshot of the premium calculator from our crop insurance decision tool. So this happens to be for one county, and it's for corn. But you can enter your quotes in here, or your APH yield, whether you're using the trend adjusted APH yield, and then it will give you the premiums for RP, ARP, the other products, and then down here is the SCO. And the SCO is something that we're going to talk about here in a couple minutes. But that's a spreadsheet that you can download. You can also go onto our website, and this is FarmDoc.
In the crop insurance section, is important to notice you'll have to click as well on the way there.
Yep, click on the crop insurance the section, and here's the payment evaluator, and I'm going to click on that, and Bruce is going to talk our way through it. I'm going to make a selection, and then we'll show you what is here. And I'm going to go into Champaign County, Illinois, for corn, and then for enterprise units.
The purpose of this tool is to simply show a representative case, a case farm per county for both corn and soybeans, and then for both basic and enterprise units, standardized to a condition we think represents the most typical farm in the county. You might find your case to be above or below, in which case you can take your numbers and go backwards and put them in the actual premium calculator. But the simple way to think about this is a way of evaluating the relative performance of different products in your own situation. So the case that's shown here is just an example. All of these are on the web. There will be one final update. We're still running the final volatility factor through. As you can see, this case was generated the day before the final number. So the only difference is that the volatility estimate was teetering between 20 and 21 on Friday before it went final. So the premiums first by county, by crop, by insurance type, and enterprise unit. There's too much to put it all in one spot, so we picked this case farm. And again, as was done on the prior screen, shows the relative cost per acre of the different crop insurance products. Going down, the next just simply says, if today's conditions were repeated a very large number of times, how much would each of the products actually pay per acre? This is a very important way of thinking about the performance of crop insurance under today's conditions. Of course, every year the projected price and volatility factors change, the rates at RMA may change, other things inside the program change. So this would not be the same table that you would get from running it last year with last year's inputs, or this year with last year's table of inputs, and so on. But every year does move around quite a bit. Likewise, important to notice is that those are numbers that can vary a lot county to county. Just to put context on one specific example, if you focus on RP 85%, the $24.05 says on average that product would pay back under today's conditions $24.05. Many years it would be zero, many years it would be larger than that, but on average it would be a value of about $24.05. Moving to the next panel, how often does it pay? just under 1 in 3 years. RP would pay, given the combination of the possibility of harvest price increasing the guarantee and paying when you had conditions, simply think about 2012 and 2014 as two remarkably different cases. The harvest price can go up and increase the guarantee, or if prices go down far enough, you can still have fairly high yields and get a payment. But in combination of all those possible outcomes, about 28% of the time you'd get at least some payment. You can think about combining the information from above, how much insurance costs, how often it pays, and what are the size of the payments, to find out what the net performance would be in your location over, again, a large number of years. This table is a bit more subtle to interpret. The negatives are, in this case, good from the farmer's perspective. This is also after the subsidy rate, and the subsidy, of course, changes depending on the coverage election. Higher coverage elections carry a lower percentage subsidy, but because the premiums are higher, the lower percentage times the higher premiums can convey a higher dollar value of the subsidy in many cases. To interpret, again, these examples, the 1046, where the RP85 product is shown, indicates that on average, RP85 would pay back $10.46 more than it cost over the long run. Again, this is expected to be a negative given the subsidy structure. Importantly, that doesn't translate directly to the best. You don't simply look at this table and say the biggest, most negative number is the best product. Some very important risk management considerations first to look at ahead of that. The next tab here, we'll go through very quickly a few of these, just says how much is the average gross revenue per acre. Let's keep going down to the VAR and say the VAR 1 as an example. And then we'll go clear to the picture after this one. In the interest of time, just because these are on the web and you can look at your own case, we just want to sort of describe the layout and let you go as interest dictates to a specific case. The VAR is a little bit more complex, but I want to start at the bottom and say if you had no insurance, the worst outcome 1% of the time would be $350 of revenue. With RP, it's roughly $500. With RP-HPE, still roughly $500. The products that paid back more over time, including ARP, if you notice, have a much lower, which is worse, VAR. In other words, they don't do as good of a job at minimizing or mitigating downside tail risk. The picture will go clear down to the bottom just to show that next. The probability of revenues with and without insurance are shown here. Let me go down just a tad more. Just to show this one, the two most vertical lines that intersect around 500 on the bottom axis are the RP products. In other words, they do the best job at cutting off low, very catastrophic revenue outcomes that might happen because of low yields, very low prices, or combinations of both. While the ARP products shown in the dotted lines push the middle of the revenue distribution to the right a bit further, they also allow many cases that are not necessarily timed well with revenue needs. They also allow many cases of sort of revenue shortfall. The furthest to the left kind of blue, almost solid line just shows what happens with no insurance at all. And this is an important thing to understand why people have, for virtually all the commercially important acreage in the state now, the last 15 to 16%, we don't think that it's realistic to expect all of those acres to ever get insurance for lots of reasons, or just some small ownership issues and some unit issues and combinations of history issues and so on. But no insurance is a much, much riskier tail than having insurance. The fact that the RP lines cut off almost all the way up to 25% indicates a very substantial reduction in risk from the use of the revenue products.
So that's the premium evaluator, and you can get that in the crop insurance website. The other thing that's here that is our iFarm premium calculator. I'm sorry, we went through the payment evaluator. I want to show you quickly the premium calculator here, and I'm going to do this, and this is going to be a lead-in to our SCO discussion. If you click on this, what we are going to do here is show you, and I went into Illinois corn grain practice, And we are going to show you premiums RP with trend adjustment, and our TA yield is 200 bushels. Our APH yield's 190. Here's our premium cost without SCO. So in this case, we could buy an 85% enterprise unit, 100 acres for $15.12. If we add SCO onto that, which we're going to discuss next, is that would cost us $16.54. In this case scenario, it's sort of interesting to note, any scenario that uses SCO, the lowest cost is $14.50, the 75% coverage level. So here you would be getting RP at 75% and SCO coverage from 86% down to there. So you can get there, get some comparisons with and without SCO.
Gary, that's again, we haven't really talked about SCO yet, but maybe we can come back to this too. But that's pretty common across most counties, at least in Illinois. You guys have found that 85% RP without SCO is pretty similar in terms of premium cost to 75% RP with SCO, and kind of plus or minus 5% on the coverage level around that area.
Yep. And you might as well give them the lowdown on SCO.
So SCO is a crop insurance program. We've talked a lot about SCO as part of our Farm Bill meetings. But one of the points we always like to make in those presentations or those webinars is that SCO is very much a crop insurance program. So this is not something that any farmer will be working with their FSA county office on. This is something that your crop insurance agent will have information on and be able to run some numbers for you. And you'd also be purchasing supplemental coverage through them along with your underlying policy. It is required if you're interested in SCO that you purchase an underlying combo product first. It is very much a supplemental insurance program, and it's supplementing that underlying individual plan. And specifically, you'd need to buy coverage either under the RP plan, RPHP, or the yield protection plan. So it does have to be one of those individual programs. You cannot combine SCO with something like the area plans. So what used to be called GRIP or what is now ARP. And one of the reasons for that is SCO is designed to cover a portion of the underlying policy's deductible range. So, for example, when you're purchasing 80 or 85% RP, those coverage levels imply a 20% deductible with 80% coverage, a 15% deductible with 85% coverage. SCO is going to provide some additional coverage on top of that for a portion of that deductible range. Specifically, SCO is going to cover from an 86% coverage level down to whatever that underlying individual policy coverage level is. So it very much depends on the coverage level that you're purchasing for that underlying plan. So SCO coupled with 85% RP is going to be different than SCO coupled with 70% RP or 65% yield protection. Regardless, though, the trigger on SCO is 86%, and again, it will go down to whatever that coverage level that you elect on your individual plan. Really key thing to understand about SCO also is that it is a county triggered product. It is not farm level yield or revenue losses that will determine whether you receive an SCO payment in any given year. It is all determined at the county level. So county trend yields, just like the area insurance plans and the same insurance prices, but there does have to be a loss either on the revenue side or the yield side at the county level for SCO to trigger a payment. Another key thing to understand about SCO is how it is in a way tied to your farm program decision. So those FSA office decisions that you're making here by March 31st. Basically, any farm that's enrolled in the individual ARC program, and when I say farm there, I'm talking about FSA farms, they're going to be ineligible for SCO coverage regardless of the crop that you plant in any given year to that farm. and any commodity with base on an FSA farm that you enroll in Ark County, any year in which you plant any acreage on that farm to that crop, that planted acreage will be ineligible for SCO as well. So just be aware there that anything you enroll in Ark could limit your ability to use SCO in the future. Finally, here on this slide, I always like to point out here, especially when we're kind of contrasting SCO with the Farm Bill programs. SCO is a crop insurance program, so it will be based on planted acreage. It will make indemnity payments based on planted acreage, and there will be no payment limits on the total indemnities that you can receive for eligible acres that have SCO coverage. Just to give you kind of a visual example of how SCO works, again, it very much supplements or provides some deductible range coverage in addition to your underlying individual plan. So here we can see if you had a 75% RP policy, that's covering your farm level revenues, starting at 75% and going down there in red. Your SCO range of coverage, which again would be triggered at the county level, but then tailored to your individual farm liability, that would cover from 86% down to 75%. So again, you'd need a county revenue loss here to trigger a payment, but SCO would be covering that range from 86% down to 75%. And then that shrinks your deductible here to the blue area, which would just be from 100% down to 86%. So again, just to try to illustrate here what we mean by some supplemental deductible coverage on your underlying individual plan. I mentioned this a couple slides ago, but just to remind you, SCO, the way that it works, the yield component for the SCO guarantee is going to be based on the same county trend or expected yields that are used for the existing area products. So again, what used to be called GRIP or GRP, or is now the ARP plan. The price component, same futures prices that are used for existing products. So for corn and soybeans, we'll be establishing the base or the projected price in February. So what is that this year for corn and beans?
$4.62 for corn, or excuse me, I'm last year $4.15 for corn. So
$4.15 for corn. So that same price they use for your RP plan or whatever will be used for SCO. And they'll be establishing the harvest price and during that same time period as well for all the crops for which SCO is available. Premium associated with SCO, and maybe when we're done talking about these points, we can go back to the slide on the premium calculator. But those premiums, the rates are set by RMA, just like all the other products. There will be a premium. It is a subsidized premium. So the subsidy rate on SCO is just a flat 65%. Doesn't matter what your underlying individual plan is. Regardless of that, they're going to subsidize the SCO premium at 65%. And then your indemnity payment, again, like I said, it's going to be triggered off of what happens at the county. So there has to be either a county revenue or a county yield loss to trigger that indemnity payment. They will calculate a percentage loss at the county level. And then that percentage loss is going to get multiplied by a farm level maximum payment. So again, it is tailored to your individual farm liability. The dollar amount you get in any given year might be different than the dollar amount another farmer in your same county might receive. That's because your APH yields differ. But the size of the loss is determined at the county, and then the dollars that you get is going to be based off that max payment per acre, which is just going to be the insurance price times your APH or trend adjusted yield, and then depending on what product you're coupling SCO with, will affect that max payment that you'll be eligible to receive as well.
And here, going back here again is premium comparison, and this is again for Champaign County. Here's an RP policy alone, $15.12, 85% coverage level, $7.36 for the 80%. If you added SCO on that $7.36, 80% coverage level, you would have a SCO product from 86% to 80%. You have no options, and there would be the cost of those two combined products together. And if you go all the way to the other end, you can see the SCO premium alone, which will go up as you lower the coverage level because you're increasing the band.
Right. And I think, again, just getting back to that point there, looking at the columns on the left, comparing enterprise units, RP, with or without SCO at the different coverage levels, I think in many cases you will see an ability to save a bit of premium. If we look at moving from, the highest coverage level on RP is 85%, you could drop down to 75% top up with SCO and save a few premium dollars. I know that's a strategy we've gotten a lot of questions about. I think we're continuing to caution people against that, just because you have to think about what you're doing from a risk management perspective when you do that, because you're trading off, much higher, better farm level revenue protection for county triggered revenue protection. So you have, like Bruce was talking about with, comparing how that group plan or area plan ARP kind of manages that downside revenue risk, and how it doesn't do as good of a job as the RP program. I think you have to make the same kind of considerations when you're thinking about adding SCO or changing what you're doing with your underlying plan just because SCO is available.
So another situation here, and let's take this Champaign County situation. You have 3 FSA farms. Well, let's make it 4 FSA farms. You enrolled 3 in Ark County. Those would not be eligible for SCO. The PLC farm would be eligible for SCO. So, and when in that situation, if you have 4 FSA farms in one county, you have to have the same RP policy for the PLC farm versus the Ark County farm. So you probably wouldn't want to lower coverage level, but you could buy SCO. And maybe, so if you had 85%, you could buy SCO from 86 to 85 and spend $1.42 on this. So, well, I'm I'm going to give you one other example here. There is a couple counties in southern Illinois, Saline County. I don't want to go there. You sort of have a different situation here in some counties. Here, the RP without SCO would be $53.6. You can see the SCO policies are much lower than that. There's some very specific counties like that. Saline's one of them. It's not all southern Illinois, by the way. It's just specific counties like that. You want to dial that in on this calculator. You can look at those sorts of things.
As we may have mentioned earlier, the difference is county to county. If you happen to be farming near a county line and have multiple counties, you may be astounded at how different the costs of insurance are and the differences in the supplemental costs, in particular, simply moving across county lines. It's largely determined by things that have happened in the past on the loss coverage and loss rates within counties and how the premium sort of loss cost ratio process works to create premiums in the future periods.
Yep, and SCO, the 2015 is the year that they're rolling this out. So you, depending on what county you're in Illinois, you maybe would have had the opportunity to buy it on some of your wheat acreage planted in the fall. But for corn and soybeans, with the March 15th closing date, I believe all counties in Illinois will be able to purchase SCO. That is not the case in all states, but in Illinois there is complete coverage of all counties for 2015. If you happen to be outside of Illinois and you want to know if SCO coverage is available for the crops you're interested in for the current year, RMA does have some maps of SCO availability by county for the 2015 crop year. The link for that is right there. You can go to that if you'd like, following the webinar, to check that out. Your crop insurance agent should also be able to tell you whether or not SCO is available in your county. SCO, again, we'll have the same sales closing date as the insurance products that you're supplementing with. So that'd be March 15th for a lot of areas here, coming up for corn and beans and other spring crops. And then just again, one more reminder, just because SCO the eligibility to use SCO is impacted by your farm program decision. We do have the March 15th closing date. We've also got the FSA program election deadline. So enrolling farms in either the PLC or one of the two ARC program options by March 31st. So it is possible that you would maybe purchase SCO coverage and then in the next 16 days decide that you want to enroll some of that acreage base related to some of that acreage into one of the ARC programs. If that is the case, if it's determined that you're insuring some acreage that is ineligible for SCO because of ARC program enrollment, that SCO coverage will be canceled for this year. And the language for 2015 is not real strong. They have the ability to forfeit 20% of your premium, but the way it's written, it kind of sounds like that's just a maybe for 2015 and a definite for future crop years.
One poll. Do you plan on using SCO in 2015 or future crop years? If you wouldn't mind answering that. We had a question. If you have RP on all farms in the county except one, put that one in PLC and take RP SCO, do you qualify for the discount, enterprise discount? The answer is yes. So if you put RP, do an enterprise, and put all your RP policies or insure it with using an enterprise unit, yes, you will be eligible for the enterprise unit discount, and you can still enroll that one farm in SCO. SCO is actually an enterprise unit in and of itself. It's either going to trigger or not trigger for a county, which and so it is an enterprise unit. All right, here's our poll. Are you using SCO for the next year? 2% said yes, 72% said no, 26% said not sure. So there's where you're at. The next major change was yield exclusion, and this is new in the Farm Bill. But here it is. It allows specific years to be dropped from the calculation of the APH yield, and more specifically, the trend-adjusted APH yield, or what you use as the guarantee yields. Those yields are determined by RMA using a very specific formula written into the law. The county, if it's eligible, has to have a 50% drop in yield, county yield, from the 10 previous years, or be adjacent to one. So if either one of those two criteria are met, that yield can be excluded from a farm's APH yield. So
importantly, it is a farmer's side decision. If you are eligible, you still get to choose whether to drop the yield in the year that eligibility criterion was met. You don't have to, and it simply eliminates it from only your calculated APH, not from your rate yield.
Yep. And here on the right-hand side of the screen is in Illinois, the blue counties are eligible for dropping 2012 for corn. So if you're in any of the white counties, you cannot drop 2012 yield. If you're in any of the blue counties, you can drop the 2012 yield. And 2012 is by far the largest number of years that can be excluded in Illinois. There are some years for you could exclude them: 1995, 2002, 2005. Again, you have to be in a county where that's excluded, and the maps for those years have many fewer counties than are shown up there for 2012. So if you're in one of the blue counties, you could drop the 2012 yield. If you want to see those maps or those criteria for YE yield exclusion, go to that FarmDoc Daily article. January 13th shows all that information for corn and for soybeans. And soybeans, there's many fewer yield drops. Here, if I can get this to go forward, is an example of how the yield exclusion will be calculated. And I'm using an example here for 2012 that it can be excluded. So this example is in a county where that yield can be excluded. And the 2012 yield here is 110 bushels per acre. So we're saying that this farm was in a drought area and had a very low yield here, and that year can be excluded. Without YE, and here we're calculating a trend-adjusted APH yield, and our trend adjustment is 1.8 bushels per year. So we're going here and adding 1.8 bushels for each year going back. So we're calculating the trend-adjusted APH yield. If 2012 is included, it's 115 bushels. The trend-adjusted APH yield gives us a trend-adjusted APH yield, 186 bushels per acre. So that would be what is used in the calculation of the TA APH yield, the guarantee, as well as the premiums. Here is what it is without the exclusion, or with the exclusion, 194 bushels. So that's leaving 2012 off. The yield exclusion in this case would allow that guarantee yield, trend-adjusted APH yield, to go up from 186 to 194. And that's going to have increase in the guarantee yield and the guarantees offered on that farm. And here, just to continue that example, is those premiums and guarantees with and without the yield exclusion. Without exclusion, the guarantee would be 656. With it, it goes up to 684. So, and that's just a function that the trend-adjusted APH yield is higher. Premiums also go up. So this product would have, this without exclusion would have $16.10 premium. Here it would have $19.88, and it's just going up because the guarantee is going up. With and without the trend adjustment, the total premium is going to be the same for the same guarantee level. So if you had a 196 bushel trend adjusted yield without or with, you would have the same total premium. If you use this yield adjustment, you will pay more for it if you keep that the same 85% coverage level. Sometimes you could drop the coverage level. Here in this case, 656. If you dropped it to 80%, you could have a 644 guarantee, and this is a little bit lower than the 656, but it would cost you less as well. This product can never cause you to pay more for the same guarantee level. YE will not cause that to happen. In general, we would say if YE is available, increases your yield, take it. So, and again, you will have higher premiums because your guarantee goes up, but you may be able to drop the coverage level. You may, given where we are at on premium or guarantee levels this year, may want to just keep that.
It is important to run this one all the way through with an actual crop insurance agent and calculate the final details, because there are some other specific distinctions, including if you lose eligibility for part of your trend because eliminating a year reduces the number of years you're able to use to calculate your trend. There are some other internal features that have to be considered. In general, the reduction in farmer-paid premium for the same bushels that can occur as a result of lower coverage levels having higher subsidy rates. As Gary indicated, for the same bushels total and the same revenue total, the total premium can't increase simply by the method used to calculate your insured yield. And so that final sort of picking the sweet spot on the coverage curve is something that you have to look at in your own individual case.
Another poll here. Are you taking YE on corn, for corn? Soybeans, there will be much more limited cases of YE. Again, if you're taking YE, you need to look at with and without YE. Sometimes, if you had a really good yield in 2012, your APH trend adjusted goes up with that yield. You want to would want to keep that yield in there. So, need to look at it. Need to and consider taking it if it increases the trend-adjusted APH yield. Here's our results for the poll. 56% of you say, yes, we're going to take it. 44% no, which is probably about where we would expect that to be, actually. All right. Coming down here, those are the new products. There's also a young farmer discount, 10% reduction in premium. It isn't age, so you can be old. You could be as old as I am and still take it if you haven't farmed previous to this. So it's really not a young farmer discount. It's really a number of years in farming discount. And if you're eligible for it, you might as well take it because it's a 10% reduction in premium. One final poll. This is going to be this is going to indicate to us where you're at in the state. Did you receive crop insurance payments in 2014? And this might be surprising, but we'll let you answer this. Because I might bias your answer, but you probably already know whether you got crop insurance. The only people that haven't received their current payments yet for last year are ARP, and you already know whether you've got them or not. 64% said no, 36% said yes. If you're in Central Illinois, Southern Illinois, you're probably not getting insurance payments. If you're Northern Illinois, you could. And it depends on what your yields were. Part of the reason for why you could be getting payments this year is because here's what's happened to the projected price last year and harvest price this year. We saw a $462 projected price in 2014. Harvest price was $349. If you didn't have a significant increase in your yield or your yield above the APH yield, you would have had a payment. This year, we're looking at projected prices for this year of $415. That compares to $462 last year. That's obviously down, and that's going to lower guarantees. Soybeans, $964 last year, this year, $1136 this year. So we're looking at again, both lowering projected prices. Both of those were set this year. February, we're done with it. So here we know those projected prices. Here just gives you a feel for what's happening to the minimum guarantees, and all of these have a 180 bushel trend-adjusted APH yield, and we're assuming an 85% coverage level. If we don't see an increase in the APH yield, we would see our guarantees decreasing given the same coverage level. Again, that's just a function of the fact that we're looking at projected prices coming down, and those minimum guarantees will come down as well. If you're wondering what happened to premiums between 2014 and 2015, here's a comparison of premiums. 85% coverage level. Premiums were $21.35 last year, and this is for a 186 trend-adjusted APH yield, enterprise unit, 100 bushels. This year it will be $23.50. Number of things have caused those premiums to change. Rate changes, which would have increased the premiums. Projected prices going down would have lowered the premiums. But the biggest factor that caused those premiums to go up was the volatility factor coming in. Last year, volatility was at 19%. This year, it is at 21%, resulting in those premiums going up. So, if you're looking at premiums this year versus last year, it's likely that you're going to be paying a bit more in premiums at that 85% coverage level. And again, this will vary across the nation and the state. $2 more, a little bit less than $1 at the 80% coverage level. Here, summarizing, here's where most of you are at. And again, it will likely be a good place for you to continue to be in the future. This is the product again. If we're looking at it, we're seeing most of you at the 90% coverage level, or excuse me, at the revenue protection at 75, 80, and 85% coverage levels. Most of you are using enterprise units, or many of you are using enterprise units, and that seems to be a good place to be. It has lower premiums. The individuals that may wish to switch from enterprise units to basic and optional generally have more variable farmland, where one area may have a yield loss while the other does not. We would also suggest looking at the trend-adjusted APH yield endorsement. Taking it, again, it will increase the guarantee yield and will increase guarantees. Premium will go up using it, but sometimes you can lower the coverage level and have a lower farmer pay premium. Yield exclusion. Take it if it's available, and it increases your trend-adjusted APH yield. That is a key. You want to make sure that it increases it for a number of reasons. We would also suggest not lowering coverage levels. In this year of cost cutting, it may be tempting to cut cost here, but the important thing also to keep in mind is that you're lowering. We're going to have lower guarantees anyway, just because of lower projected prices, and that's going to put us at more risk. Here again are the RP premium cost. Again, here we just want to illustrate the difference between basic and optional units. And again, if you're at enterprise units, they're usually very much lower cost. And using enterprise units and going at a higher coverage level is probably the way to go. It will definitely provide more risk protection than will be the lower coverage levels. Some of you may be interested in RP with harvest price exclusion, and again, we've seen limited use in this in the past, very low acres. The people that this may suit is those who do not do much pre-harvest hedging. And if you do some pre-harvest hedging using this product, if you do pre-harvest hedging, you actually take off the revenue protection offered by the crop insurance product. You have to be very cost conscious, and you're going to have to be willing to take the drought year risk of getting no or low payments. So here is the difference in premium cost. $22.47 for RP enterprise units. You can cut it in half using RP with harvest price exclusion. So you're in that is the cost savings that's available by using RP with harvest price exclusion. Remember though, 2012, you would have cut your insurance payments in at least half, and in some cases you would not have gotten crop insurance payments in 2012. To illustrate that, I just put a drought year scenario. Let's say we have a drought year, 550, 120. If you had 120 bushel AP or farm yield, 550 harvest price. This is set up for 2014. So we're looking at a 415 projected price, and I was using 185 bushel yield. You can see the payments here for revenue protection. RP would have not made a payment in those scenarios. So that's the trade-off. You save premium, but you will not, in those drought years, you will get lower payments, and we would suggest looking at, in those cases, not doing much pre-harvest hedging.
We had a question come in. Can you give a quick description of volatility? The honest answer to that is no. It's a complicated idea. Our best attempt at that, though. Volatility is a measure that RMA uses to characterize the degree to which prices can change between crop insurance sign-up and the date at which final revenues are determined. It's pulled from the futures and options markets in the following way. If you use the Black-Scholes model to price an option, there is one value of the volatility that will result in the prices that are actually observed in the market. RMA uses this idea of an implied volatility, or what measure of variability in prices would have resulted in the actual values of prices of options traded, to calibrate the price distribution used in pricing insurance. In simplest terms, it's a measure of the uncertainty around price. When it's higher, there's greater uncertainty around price. When it's lower, there's less, or we're more sure that today's prices will hold through harvest. There is a very substantial premium impact, though, at any given level price. For example, going from a 20 volatility to a 21 volatility will average about a 5 or a little higher than that, 5% increase in premiums to go up roughly 5% of the starting volatility value. That's why it's a very closely watched number.
That's why this year also, when we saw our movement from 19% last year to 21% this year, we saw that those premiums, if we had had a 19% or 0.19 volatility this year, our premiums would be lower than last year.
By almost 10%, yes.
Final product, who should take ARP? And this is the county level product. So you're going to introduce yourself to some basis risk, if you will. The county may have a loss and your farm doesn't, and vice versa. County may not have a loss and your farm could have a loss. We would suggest if you're going to take this, take it at 90% coverage level, and then vary the protection factor. Higher the protection factor, the higher the payment, and the higher the premium. Here's the people that are individuals that may wish to take ARP. Those that are concerned with more price risk can only, for whatever reason, take basic or optional units. If you're in that situation, the premium difference between ARP and RP will not be as big. And for whatever reason, your APH yield is much lower than your expected yield. This might be because you picked up land in a new county and you're using transitional yields, so that if you're in that situation, ARP will be a much more attractive alternative. Here's a look at the premiums for this. Then this is one county. This is Macon County. Those premiums will vary tremendously across years and counties. So one county adjacent to another, ARP premiums can be much different. So really, you got to look at this on a county by county basis. And here it is for Macon County, and it will vary even to the counties next to it. So summarize here. Most of you, by statistics and by the polls you answered, say you're in RP or ARP. If you're there last year, probably just as good to be there this year at a pretty high coverage level. If you're thinking about RP with a harvest price exclusion, it's a good place to be. But remember the drought sort of scenarios that you're looking at, and you probably do not want to do much pre-harvest hedging. YE, use it if it's available and it increases your trend-adjusted APH yield. Beginner or young farmer discount, if you're available for it, take it. SCO, big thing about SCO, if you have a farm, don't lower your coverage level, particularly if you have a mixture of PLC and ARC County farms. And take it if it's available and you're interested in that sort of coverage. This webinar will be archived, so you can go to our farmdoc website and take a look at it. Appreciate your time this morning. Any last thoughts from Nick or Bruce?
No? Any questions from the audience? we've answered everything that's come in so far.
Well, it is 9:00. We do appreciate you spending an hour with us this morning. I don't know what that says about you or us, but we're here and you're here. And we appreciate your time, and hopefully get those decisions made and have a good and safe spring.
Thanks.